In 2008, the world watched in horror as Bernie Madoff was led away in handcuffs. He had orchestrated the largest Ponzi scheme in history, defrauding investors of $64 billion. The mechanic of his crime was simple. He used the money from new investors to pay the profits to the old ones. It was a mathematical lie, a house of cards that required an endless stream of new victims to keep standing. We call Madoff a criminal. We call his scheme a fraud. But what if I told you that the exact same mechanism, using new money to pay old promises, is currently the bedrock of the entire global economy? It isn't run by a criminal mastermind in a Manhattan penthouse. It is run by your government. It is run by the world's largest financial institutions. And the amount of money at stake isn't $64 billion. It is estimated at over $78 trillion. This is the story of the pension system. For the last 70 years, we have been sold a promise. Work hard, contribute to the pot, and you will enjoy a golden retirement. It is the ultimate social contract. But the math behind that contract has broken. The vault is empty. And the people who are supposed to pay for your retirement simply haven't been born yet. We are witnessing the slow-motion collapse of the greatest Ponzi scheme ever invented. And unlike Madoff's victims, you cannot opt out. To understand why your future is in danger, we first have to strip away the comforting lies of politicians and look at the cold, hard mechanics of a pension fund. Most people believe a pension is like a savings account. You put $1 in a box, it sits there for 40 years, maybe grows a little, and you take it out when you're 65. That is false. Most public pension systems like Social Security in the US or state pensions in Europe are what economists call pay-as-you-go systems. The money you pay in taxes today is not being saved for you. It is immediately transferred to a retiree living down the street. This system works beautifully under one specific condition. You need a massive base of workers at the bottom of the pyramid to support a tiny group of retirees at the top. But something fundamental has shifted. We call it the demographic winter. The base of the pyramid is shrinking, and the top is getting heavier. But that's only half the problem. The other half is what the financial world calls yield chasing. Because there aren't enough workers to pay the bills, pension funds have turned into gamblers. They are taking your future safety net and betting it on risky leveraged assets just to keep the lights on. The system is fighting a war on two fronts: biology and mathematics, and right now it is losing both. To see where this ends, we have to look at where it began. The story starts not with a banker, but with a general. In 1889, German Chancellor Otto von Bismarck invented the world's first state pension. It was a political masterstroke designed to quell socialist unrest. But here is the catch that history books often leave out. Bismarck set the retirement age at 70. At that time, the average life expectancy in Germany was roughly. Do you see the trick? Retirement wasn't designed as a 20-year paid vacation. It was insurance against living too long. It was a bet the government knew it would win because almost everyone died before they could collect a single mark. Fast forward to America, post-World War II. The baby boom created a demographic miracle. For every one retiree, there were 42 workers paying into the system. With a ratio of 42-1, the government was swimming in cash. Politicians looked at this surplus and made a fatal mistake. They expanded benefits. They lowered the retirement age. They added cost of living adjustments. Promised the moon because the money felt infinite. They didn't realize they were spending a temporary windfall. They built a permanent system on a temporary demographic spike. Then, the music stopped. Look at the city of Detroit. Once the wealthiest city in America, the engine of democracy. By 2013, it was bankrupt. Why? It wasn't just corruption, it was math. Detroit had promised generous pensions to police, firemen, and city workers during the boom times. But as the population shrank and the auto industry declined, the ratio flipped. You had fewer taxpayers trying to support a massive army of retirees. The city tried everything. They borrowed money, they sold assets. But the math always wins. In the end, the pensions were slashed. The promise was broken. Detroit is not an outlier. It is a preview. It is the ghost of Christmas future for the entire Western world. If we analyze the collapse of pension systems throughout history, we see a clear, undeniable pattern. It operates like a machine with 5 distinct stages. Stage 1 is the demographic dividend. The system launches during a population boom. The worker-to-retiree ratio is high, usually above 10-to-1. Cash reserves overflow. Politicians use this free money to buy votes by promising generous future benefits that come due for decades. Stage 2 is maturity. The workforce growth stabilizes. People start living longer thanks to better healthcare. The ratio drops to 5-to-1. The inflows perfectly match the outflows. The system seems stable, but the surplus is gone. This is the moment to reform, but no one does. Stage 3 is the inversion. Birth rates crash. The baby boomers begin to retire en masse. The ratio drops below 3-to-1. Suddenly, the money coming in isn't enough to pay the people cashing out. The system begins to eat its own capital. Stage 4 is what we call the yield chase. This is the danger zone. Panic sets in. To fill the gap without raising taxes, which is political suicide, pension funds stop buying safe government bonds. They move into higher-risk assets, private equity, commercial real estate, and complex derivatives. They use leverage to try and manufacture returns that don't exist. This transforms boring pension funds into aggressive hedge funds. And finally, Stage 5. The math reality. The risks blow up, or the demographic weight becomes too heavy. The scheme requires a massive bailout, which means printing money, or a default, which means cutting benefits. Right now, the United States, Europe, and most of East Asia are deep in Stage 4. You might think, this won't happen to me. But if you look at the headlines, the cracks are already visible. In 2022, the United Kingdom almost collapsed. Why? Because British pension funds were in the yield chase. They had engaged in a complex strategy called liability-driven investment. Effectively, they used leverage borrowing money to buy bonds. When bond prices fell, they faced a margin call. The Bank of England had to step in and print billions of pounds overnight to save the pension funds. If they hadn't, the retirement savings of an entire nation would have evaporated in a single afternoon. That was a warning shot. Look at the numbers today. In the U.S., the ratio of workers to beneficiaries has fallen from 42-to-1 in 1945 to just 2.8-to-1 today. By 2035, it will be close to 2-to-1. 2 workers cannot support themselves, their families, and a retiree. The math is physically impossible. To make matters worse, we have the unfunded liabilities problem. This is the gap between what the government has promised to pay and what it actually has in the bank. Citibank estimates that the total value of unfunded government pension liabilities across 20 major economies is $78 trillion. That is nearly double the combined national debt of those countries. We are seeing the desperation play out in real time. Why do you think France rioted when the retirement age was raised by just 2 years? Why is Japan the oldest society on Earth normalizing the idea of working until 80? Because the Ponzi scheme is running out of new investors. So what happens when the check comes due? We are heading toward a bifurcation of society. Governments have only 2 choices, and both are painful. Option A is the soft default. This is the path of inflation. They print the money to fill the hole. They fulfill the nominal promise. You will get your check for $3,000 a month, exactly as promised. But because they printed trillions to fund it, a loaf of bread costs $50. They pay you in worthless currency. This is the most likely path because it is the easiest to hide from voters. It's a stealth tax on the elderly. Option B is the hard default. This is austerity. They cut the benefits. They raise the retirement age to 75 or 80. They means test Social Security, telling you that if you were responsible and saved your own money, you don't get a check. This breaks the social contract explicitly. But the cultural consequence is even more profound. The concept of retirement. The idea that you stop working at 65 and play golf for 20 years will likely be remembered as a historical blip. A brief golden accident of the 20th century that never happened before and will never happen again. We are returning to the historical norm. You work until you can't. And here is the terrifying part. The pension funds, in their desperate yield chase, are currently propping up the stock market and the bond market. They are the biggest buyers. If they are forced to sell assets to pay retirees, asset prices crash. It is a negative feedback loop that could trigger a depression worse than 1929. When the pension Ponzi breaks, it doesn't just hurt retirees. It breaks the bond market, the stock market, and the currency itself. Bismarck didn't build a system for a world where people live to 90. He didn't build a system for a world with shrinking birth rates. We have built our entire life plans on a promise that was mathematically flawed from the start. The Great Pension Ponzi isn't about malice, it's about denial. We refuse to accept that the demographics have changed. The era of relying on the state to fund your final decades is over. The social contract is being rewritten, whether we like it or not. The only person coming to save you is you. If you want to understand how to protect your wealth when the safe systems start to fail, make sure you're subscribed. In our next video, we are going to break down the specific assets that survive inflation and currency debasement. History is a relentless teacher. Don't be the student who didn't study for the final exam.